Hi, welcome to On Investors Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at J.P.Morgan Asset Management. And thank you for giving us a few minutes of your time to learn about what investors are thinking about right now and how that fits in with your portfolio construction. Now, of course, what's on investors' minds right now is the US presidential race. President Biden has just withdrawn as a candidate from the race, and while we wait for the new Democrat nominees, there are clearly plenty of questions that investors in Asia Pacific and globally are asking about right now. So I'm delighted to share with you this webinar that was recorded on the July 22nd Asia time in the evening, hosted by the Global Chief Strategist, Dr. David Kelly, and he's joined by Liz Herman, who is our Federal Government Relations Director. They will share with us a lot more in terms of what's going to come in the election race, as well as what does that mean for both the presidential and congressional elections, as well as fiscal and monetary policy. And of course, most importantly, what does that mean for investors around the world? So enjoy, and please let us know what you think. And if you have any questions, please reach out to your J.P.Morgan Asset Management client advisors.
Good morning, and thank you for joining us today. My name is Stephanie Aliaga, and I'm a global market strategist here at J.P.Morgan Asset Management. Yesterday, President Biden announced that he is ending his campaign for re-election and formally endorsed his Vice President, Kamala Harris, for president. This comes after weeks of mounting pressures for him to step down from the race and adds a new layer of surprise and uncertainty to what has already been a dramatic election year. Clearly, there are several questions that investors are now parsing through. What happens next for the Democratic Party? How does this change the expectation of who wins in November, and particularly the odds of a Republican sweep, which markets had begun pricing in? And ultimately, what do investors need to pay attention to in the midst of all of this? To shed some lights on these issues, and importantly, to give us all a structure for how to put this in the context of the broader investment outlook, I'm really glad to be joined by our Chief Global Strategist, Dr. David Kelly, and our Federal Government Relations Director, Elizabeth Herman, today. David and Liz, thank you both for joining us on short notice. I've teed up a number of questions to get us started today, and then afterwards, we will take questions from the audience. So for those of you joining us via webcast, you can submit your question through the box on the left-hand side of your screen at any point during this webcast. Now, David, before we get started, I wanted to give you a chance to share any comments you'd like before we get started here.
There are really two things I want to say before we get going. The first is this is a call about investing and investment implications. I realize that what's prompting this is politics, and I know people have got strong political opinions in this country, and they're entitled to them. But our job is to sort of analyze the economy, markets, policies, and think about what it means for investing. So we're going to focus on that today, and both in our comments and also in the Q&A. And the second thing is a lot has happened, and it reminds me to some extent of different crises and events we've had over the years. And when you have something like the pandemic or the great financial crisis or an issue like this, you get bombarded by information. I think the most important aspect of making good decisions really comes from having a structure in how you approach this. So what we're going to try and focus on is really four things: the logistics of how the Democratic ticket is chosen at this stage, how that impacts the probabilities in terms of a Republican sweep, a Democratic sweep, or a divided government, and what kind of divided government. What are some of the policies that might change depending on what sort of configuration we have in Washington? And fourth, what are the implications for investing? So I look forward to talking about all of those things. But with that, I'll pass it back to you, Stephanie.
Awesome. Thanks, David. So Liz, I'd like to start the first question off with you as it pertains to the logistics of what happens next. Biden and a number of other senior Democratic leaders have come out in support and endorsed Kamala Harris for vice president. She seemingly also stands to inherit the existing Biden campaign. How big of an advantage of that is that? And can anyone else jump in at this point and challenge Kamala for the nomination?
It's a great question. What we're seeing now is this very, very rapid coalescing of the entire Democratic Party, from the state level to the national level to party leaders. even labor unions coming around and putting out their endorsements for Vice President Harris and following the president's recommendation that they endorse her. This is really closing off any opportunity anyone would have had to throw their own name into the hat. At this point, so much of leadership in the states and federally are putting their names in Kamala Harris's camp that it would be almost pointless, almost, I would say, for someone else to raise their hand and say, what about me? Because so many people are lining up behind Harris. So at this point, the narrative has really changed. It really does seem like Harris is the presumptive nominee, and it would be unusual for anyone to come out and challenge her at this time. It is still open, they still could, but it would be difficult to figure out where their support would come from. What we're watching for the immediate future is, first, this long line of endorsements will continue. We still do not have endorsements from people like Schumer, Leader Jeffries, even the Obamas. We do expect those to come later in this week, and more endorsements to, of course, follow for those who haven't done it already. We expect her vice president to be chosen. She's still just on her own name as going to be the top of the ticket. She'll need a vice president. There's lots of names floating around there of who that would be. And of course, she would need to be named as the actual candidate through a vote of the delegates. We still do not expect that to happen at the Democratic National Convention on the 19th of August. That was the view for both Biden, is also the view for Harris, that the Democrats are not going to wait all the way until late August to coalesce around a candidate to make it official. Instead, they will get that official nature of this by confirming her at a roll call vote done essentially over the phone or through Zoom. That would probably be early August. We're hearing as early as maybe August 6th or 7th, just to formally have that vote for the delegates officially nominating Harris, and whoever that nominee is for her vice president would also be confirmed on that day as the official nominees. It is a huge advantage to have so much of the Democratic Party lining up behind her and sort of setting up this entire campaign around her so that they can sort of move on, turn the page for this campaign, and have her running at the top of the ticket.
And when it comes to the other logistics around this, does Harris can she get all of the funds, I guess, that the Biden campaign has accumulated, during its time? Is it very easy for her to just kind of access those?
Yes, it's a tremendous advantage to her versus anyone else who could have possibly challenged Harris to be the frontrunner in this campaign. Because she was on the ticket already, it was very easy to just sort of switch it out. It is now the Harris campaign. It was the Biden campaign. All of the money that is directly tied to the campaign has transitioned to her. The super PACs, those groups that are not officially tied to the Democratic Party, but we know are raising money in support of the Biden campaign, have now all come out today, many of them, and said, we are going to switch our support to supporting Harris. So it was shockingly easy, I would say, in the last 24 hours to see how they were able to switch all of the fundraising directly to Harris. There are no complexities that we can see at this time that would make it difficult for to access the funds.
What do you think are the key priorities for now a Harris campaign in achieving unity within the party, but also making her case to voters? And, she hasn't been as visible during her time as vice president. How could she perhaps, address that?
For Harris, on policy points, we expect it to be very similar to what we saw in the Biden campaign. So much of what Biden was campaigning on was, look what I've done for the last 4 years. Look at issues for investment in infrastructure and climate from the Inflation Reduction Act, from the infrastructure bill. Here's our points on reproductive rights or immigration, other things that we've seen from the administration pointing to their 4 years of work. Harris was there in the White House. We would expect her to continue to point to it, saying, this is my victory too. As the vice president, this was my 4 years. This is my legacy. The campaign would be very, very similar on those policy points. Where it would be different is, of course, like the narrative around the campaign that's more political. This is no longer going to be a campaign where the narrative in the news on a daily basis is two men in their late 70s or early 80s running for president. We now have a candidate who is in her 50s who's on the ballot. So this narrative about somebody being old is sort of going to fade away. We may still see it from the Republican side, arguing that, it is bad for Democrats to have had Joe Biden in the White House in the first place. That is a natural political attack. But it is much, much harder when your candidate at the top of the ballot is only in their 50s, a generation younger than the other candidates.
Yeah, and that's the next big question, right? So how does this improve the Democrats' chances of winning in November? Obviously, a lot has happened in a short amount of time, but pollsters have been polling Kamala with voters. How does she do relative to Trump compared to Biden?
We will get some really good polls in the next few days. It is amazing how much any polling that was done was sort of done without the giant campaign apparatus around her. She has been the vice president. She's been a national figure. She ran for president, of course, in the last cycle and lost to Joe Biden before she was named vice president. She's been a senator, but there's still a lot of Americans who probably don't have a good sense of who this person is and her own background. We think the polling will shift as the Democratic campaign really ramps up, trying to sort of paint her own identity for voters. And the Republicans will do the same. We think voters may change their opinions as they learn more about her. The one thing that is notable is truly how similar a lot of her polling has been to Biden. Their approval ratings are, in terms of voters who like them, for Biden, it's been 36% recently. For Harris, it's been 38%. Trump was at 41%. Not great ratings. The goal being we can improve this if an entire campaign is built around, short of reintroducing her to voters. Similarly, both have done better among younger voters. Younger voters favor Biden and now favor Harris by a number of points, at least 15 points. However, older voters have continued to favor Trump over Harris or Biden by 15 points. Those are voters over the age of 65. We may see these numbers shift as Harris's campaign gets off the ground, as more voters get to know her. But so far, it is really a story of two electorates, younger voters and non-white voters, more closely aligned with Democrats, older voters, white voters, especially male voters, being more aligned with Trump. We will see if that shifts. I also would note that the new poll numbers that are going to be coming out are going to be pretty great for Donald Trump. He just had his convention. There is a traditional post-convention bump. It is usually several points. Anyone coming off their big convention where they've had a big splashy week all over the news is likely to poll much better in the weeks following the convention. So we do think any numbers that are coming out are going to show that convention bump and not as much for Harris at this time.
Yeah, that brings me to one of my other questions around excitement from voters and how that affects potential voter turnout, right? Do you think that is a big advantage for the Trump campaign right now? And is there any hope for the Democrats to kind of reinvigorate voter enthusiasm around a female candidate?
Voter enthusiasm is key here. No matter what these polls tell us, whether it's a national poll, whether it's a swing state poll, it matters if those voters who are actually sharing their opinions show up on election day. And the most recent polls we had from just 2 weeks ago were really sort of depressing. They were showing us that only about 25% of Democrats were excited about who was at the top of their ticket. 75% preferred it was somebody else. On the Republican side, it was the polar opposite. It was high 70s, low 80s of the Republicans who were polled saying, I'm excited about who's at the top of my ticket. The balance, of course, not being excited about it. With those sorts of numbers, that was telling us that Republicans were excited about who was in the ballot for president. They were going to show up. Democrats, not excited. Maybe they stayed home. If the Democrats can get that to shift now that they have Harris, they may have a better shot here. They will have more people showing up on election day, ideally to vote for Harris, but also for those down ballot candidates. This whole thing is not just based on the presidency. It is based on how do Democrats preserve margins in the Senate. They are currently in the majority, 51-49. They're hoping to keep that as close as possible next time. And they are down just a handful of seats in the House, and we're hoping to reclaim it. This isn't just about the presidency. It's turning out Democrats to the polls, turning out independents, so that they're not just voting for Harris. They're not just voting for Biden. They're voting for the Senate candidates. They're voting for the House candidates, and it affects the down ballot races. All of the control of Washington is based on who's turning up.
Thank you, Liz. David, I want to bring you in here too. How does this, in your opinion, change the distribution of probabilities of who wins the House, the Senate, and the White House as well this November?
Well, as Liz said, it's very early days. It's not so much that it's necessarily too close to call. It's certainly too early to call. We have to see what, Vice President Harris has had pretty negative poll ratings, but on the other hand, I can't remember any time that a vice president looked good. It's the least flattering office in government, and so vice presidents tend to have negative poll ratings. We'll have to see if that impacts those numbers going forward. And I think, as Liz said, I think turnout is crucial here. But on the White House, the Democratic path to victory, the simplest path would be to keep Wisconsin Michigan, Pennsylvania, and Virginia, which actually has now swung slightly Republican. If those 4 states stay in the Democratic camp, they would still win by 270 to 268, which of course is the narrowest of margins. But I think that may have an impact on who Kamala Harris picks as a running mate. But it's just too early to say on the presidency. Within the Senate, yes, the Democrats now have a 51 to 49 advantage. They hold a Senate seat in Montana, held by John Tester. Montana is not by any means a Democratic state, and John Tester is down in the polls. And if they lose that too, then the Republicans control the Senate 51 to 49. If Donald Trump becomes president again, then 50-50 gives the Republicans control in the Senate. Even if he does not become president again, if it's a President Harris in a few months' time, 51-49 obviously gives Republicans control of the Senate. So the odds are the Republicans do end up controlling the Senate. And then in the House, it used to be that the House seemed to be that the Democrats had to achieve a big majority in the popular vote in order to take the House. That was overturned by the 2022 election, where the Republican majority in the House actually didn't fully reflect the Republican majority in the popular vote. So that suggests that if you have a very close election, the Democrats could still take the House. But it looks like at the moment, it looks like it'll probably be close. And that in itself, even if you have a Republican sweep or a Democratic sweep, the closeness of it could affect what policies actually get out of Washington, because there are always some members of your own party, either on the extremes or in the middle, who will tend to ruffle feathers and make legislation more difficult to pass.
Thank you, David. So we've obviously talked a lot about how this changes the state of the race and the probabilities for who wins in November. But a lot of the questions that we're getting in, and really the second half of this call, we really want to focus on what the policy differences are between these two potential administrations. So David, could you please outline for us what those major policy discrepancies are, and what could we expect to actually be implemented or changed in this next administration?
All right, so I'm going to briefly go through 8 things: taxes, trade, immigration, energy, healthcare, defense, monetary policy, and regulation. And so that sounds like a lot, but let me go down the list. So first of all, on taxes, the big issue is the Tax Cut and Jobs Act of 2017. When that was passed, because of Senate rules, a lot of the provisions expired at the end of 2025. And if you have, and those are particularly tax cuts for individual income tax. The corporate income tax cut was permanent, but the individual income tax cuts ran out. So that's up for debate. The estate tax is up for debate, and the state and local tax deduction is up for debate. So if you have a Trump victory, and particularly if you have a Trump victory and a Republican sweep, we'd expect all of the Tax Cut and Jobs Act to essentially be extended. So you get an extension of those tax rates, and you probably also have an extension on the cap on SALT deductions and state and local tax deductions. So pretty much as is. Now, you would also, though, if you have that, we will see increasing deficits. The Congressional Budget Office put out a forecast back in June, which showed that if you don't extend any of it, the debt will still go from 99% of GDP this year up to about 124% of GDP by 2034. If you fully extend the Tax Cut and Jobs Act, it might go up to about 133% of GDP. Under Harris administration, if there was a Democratic sweep, I would expect that some of the things that outlined in President Biden's campaign would be they would try to implement. So that would mean that yes, most of the tax cuts for less well-off individuals are sustained, but the top tax rate, which is currently 37%, would revert to 39.6%. In addition, right now there is a deduction or an exemption in the estate tax for almost $14 million per individual in a couple. That could, even with the inflation adjustments, that could revert to about $7 million under a reversion of estate tax rules. So the estate tax would likely change. I think the SALT deductions also, actually, the cap would expire, and I would expect that that cap on SALT deductions really hurts the coasts. And so I'd expect that would be allowed to expire. So you get slightly different nuances both ways, though. The deficit goes up significantly, or the debt goes up significantly the years ahead. I don't see fiscal consolidation on either side. Looking at trade, this is an area where a president has a lot of say. Over the years, Congress has really ceded a lot of power to the president to make trade policy. By declaring various kinds of emergencies, you can push up tariffs. But I'm not sure under either scenario whether you're going to get significantly higher tariffs. First of all, both the Biden administration and the previous Trump administration had raised tariffs. The Trump administration was more aggressive in tariffs than the Biden administration, but both of them seem to be willing to raise tariffs. But on the flip side, tariffs are, as an economic policy, quite problematic, to say the least, because they will tend to slow down global economic growth. You put a tariff on them, they'll put a tariff on you. Exports for both countries decline. In addition, they will tend to mess up supply chains, as they were doing in the late part of the last decade, and that adds to inflation. So if you want to, the problem with tariffs is a tariff solution both slows the economy and increases inflation. And it's quite possible that whoever the next president is, they try to negotiate tariffs down rather than push tariffs up. So you could talk about tariffs, but still be open to a big deal. On immigration, I think you'll see more restrictions, but very likely much more aggressive restrictions under a Republican sweep than a Democratic sweep. The real question is not just border policy in the southern border, though. It's also how many immigrant visas you allocate every year. And too much, the current situation is clearly chaotic, but too much restriction could also restrict the growth in the labor force. And I think both parties know that. And so while I don't think either party will give up the opportunity of using this as a political cudgel, I expect that you won't see quite as dramatic a change, particularly with regard to legal immigration, as some people might expect. On energy, I think a Republican sweep is more pro-fossil fuel. A Democratic victory is more pro-green energy. Although most of the money spent in the Inflation Reduction Act was really focused on the green energy transition, that's already heading to the states, and I suspect you won't see a full reversal of that. Healthcare, I don't think anybody's going to really mess with Obamacare at this stage. Defense, it does seem that a Trump administration might be less favorable to NATO, and indeed to, I think there's some issue about the defense of Taiwan also. So I think you would see a more of a insular U.S. policy with regard to defense. On monetary policy, I think under President Trump, you saw the last President Trump, last time he was president, he did sort of browbeat the Federal Reserve a lot more than previous Republican or Democratic presidents have done. I think that would still be the case, but there is a limit to what the president can do to the Federal Reserve without congressional approval or without Senate approval in terms of hiring and firing. Moreover, it's not even clear in what direction you'd want to browbeat the Federal Reserve. Do you want them to be more aggressive and possibly threaten recession, or be less aggressive and possibly threaten inflation? So back in 2019, it was clear to the Trump administration that they wanted easier money. Now it's not clear that that would be the case. And so maybe you don't see quite so much of an attempt to pressure the Federal Reserve. And then finally, on regulation, it used to be that Democrats mostly did what big business did, and Republicans always did what big business wanted, or that's what people used to say, is that American politics on both sides really was very favorable to big business. Kind of almost in the opposite of that now. At this stage, we've got an aggressive antitrust policies being adopted by the Biden administration, but really endorsed by, for example, J.D. Vance, the Republican nominee for vice president. So it's quite possible that in both cases you will see a certain amount of extra regulation of big companies, even though you might see some deregulation in terms of what smaller companies are supposed to do, particularly under a Trump administration. So those are just some of the thoughts, and I know I went through that very fast. But those are some of our thoughts in terms of how this could affect policy. But the one thing I would say about this is it does depend a little bit on how big a majority. You end up with a very tightly controlled Washington in terms of the House or the Senate after election day, the chances of achieving big policy change are much reduced.
Thank you, David. So there's a number of different areas where the two sides definitely differ, and there's some surprisingly where actually they may share more in common than you might expect, particularly on the regulation front, big tech, and on tough on China. Now, for the most part of this year, markets more or less shrugged off the elections, right? We notched 37 all-time highs in the markets. It wasn't, really that top of mind for too many Americans, but that's changed in recent weeks. And particularly, I think in the last week or two, as expectations for a Trump victory and a red sweep really rose, you saw, more talk about the Trump trade. And that being ascribed to some of the rotation that we've seen in the market. So small caps have had a really significant rally. You've seen a movement away from the momentum, big tech names towards other lesser loved areas of the markets. What do you think a Trump trade curtails? How might markets perform under a Trump victory or a red sweep scenario relative to a Democratic victory?
Well, I think one of the interesting things we saw a few weeks ago was after the first debate, and that was really a bit of a seismic impact on probabilities because it was clear that President Biden lost that debate very badly. And that increased market perception, and you could actually see it in literal betting odds on a Trump victory and on a red sweep or a Republican sweep. You could see that happen the moment after that debate. And what we also saw was interest rates moving up somewhat, but also, as you say, we've seen this rotation. And I think that means sort of twin things. It's a mixed picture. The argument is that you would get lower taxes, but higher deficits, both of which might increase inflation, possibly nominal economic growth, but also overall government debt, which would tend to push up interest rates. So it did make sense that long-term interest rates moved up, but also you saw this rotation, as you said, the idea that you might have less regulation, particularly as it impacts a small business, that could be seen as a positive to business, and that would help that out. What I think was interesting yesterday and this morning is we're not seeing much movement, and we have not seen much movement in interest rates. We've not seen much movement in the equity market. I think that springs from two things. One, it's had three things. One, we're not really sure where this is going to land. I think, what we can say is uncertainty has increased, but it's still very murky as to who's going to win. Second of all, there is, the differences in policy between the Republican Party and the Democratic Party are curiously maybe not as extreme as they used to be. I mean, it seems that it's almost the extreme right and the extreme left are so extreme that they sort of meet around the other side. And they both seem to have a disdain for big business and for monopoly power, even though obviously with the concentration we're seeing in our markets, monopoly power is alive and well. And then the third thing I would honestly say is this year and last year, it's not good news is bad. Bad news is good news, or good news is good news. All news seems to be good news. I mean, markets have been able to look at the sunny side of almost every piece of news item we've seen. So I wouldn't necessarily take too much of a cue from how markets behaved overnight. But what I think it does say is there's actually a lot of uncertainty about what this means for markets. And the key takeaway here is it's not just about the president. And it's not even just about government policy. We've seen markets get very distorted in the last few years because of years of low interest rates and then a lot of momentum and a lot of excitement around AI, a lot of excitement around the US equity market relative to other US markets. So markets are quite unbalanced. A lot of investors are quite unbalanced. And I think the important thing is to look at valuations and what the direction is for these industries, even forgetting for the moment about government policy, but take a careful look at whether markets are somehow mispriced internally at this stage and whether you are offside or onside relative to a correction of that, because it's quite possible, regardless of what happens in November, that we will get a significant correction. We're certainly overdue. And if we get a correction, the things that are most overvalued are obviously things that are most vulnerable.
Thank you, David, for that. I want to double click into a few of the points that you made here. Perhaps we'll start with interest rates. Now, you mentioned that we've seen this steepening in the yield curve over the last couple weeks. How much of that do you think is due to expectations for the Fed to finally lower interest rates? Maybe under a Trump presidency, you see that happen more expeditiously. Do you think that markets are expecting that? Or do you think that it's perhaps the kind of resurface of a term premium, and whether just regardless of who wins, we are in this new world of higher political uncertainty, and maybe that warrants some kind of premium on our debt?
Yeah, I think it's a little bit of all of those things. So uncertainty, you would think, would actually increase term premium, because if you're investing in cash, you kind of know what you're going to get. If you're investing in 10-year bonds or 30-year bonds, then it really depends on future policies. And if future policies are less certain, you could sort of see why you need a premium to hold them. That's one part of it. I think the second part, as I mentioned, is after the first debate overnight, you could see those higher interest rates, which does suggest the idea that you might have somewhat more debt and somewhat more inflation under a Trump administration, but not by a lot, because it was only a minor move overall. And then I think the third thing that's affecting the yield curve is we have seen some economic data in recent weeks, all of which showed some moderation. If you look at the employment report, you look particularly at the wage component, wage growth has come down some more. If you look at the CPI report, it definitely saw a crack in owner's equivalent rent, and we're going to get a consumption inflation number this week, which I think could be a 2.3% or 2.4% year over year, which is really not very far away from the Fed's 2% target. I think we will get a strong GDP print for Q2, but you got to look beneath the surface there, because that's a lot of that is inventory accumulation. And if you take out inventory accumulation, growth seems to be slowing too. So what's happened is at the start of the first quarter of this year, and Jay Powell has talked about this, a lot of the good data they were expecting in inflation didn't transpire. Now it is beginning to occur, and we're seeing a moderation in economic growth. And I think that is really what's building in expectations that the Federal Reserve can cut in September, in December, throughout next year. And that's bringing down expectations of short-term interest rates, even as the idea of significant government deficits for a long time to come are keeping a floor under long-term rates.
And what might this all mean for the path of the dollar? We've obviously had this long period of dollar strength in the last few years. I know some presidential candidates have made comments about where they'd like to see the dollar. And what could this mean for, I guess, U.S. versus international markets?
Very interesting point, because yes, it's been a mantra for many, many years under both Republican and Democratic administrations that, well, first of all, the Federal Reserve doesn't make dollar policy. The Treasury does, to the extent we have a dollar policy. And under both Republican and Democratic administrations, the idea is we like a strong dollar. And that's what the mantra has been. But now you've seen both Donald Trump and J.D. Vance talk about the merits of a weaker dollar because it could help exports. I think obviously we want a fairly stable transition in terms of the dollar, but the dollar is too expensive. And it has the rise in the level of the dollar has cost millions of manufacturing jobs over the years in the United States. So there is a strong case to be made, particularly if you think inflation is coming down anyway. There's a strong case to be made for a lower dollar, and that is a much cleaner way of achieving more balance in trade than tariffs. Tariffs, somebody can respond to with more tariffs, and so you both stop exporting, and that's not good for anybody. But a lower dollar, which made U.S. goods cheaper overseas and made foreign goods more expensive here, there are some merits to that, and it's interesting that that on the Republican side they're sort of embracing the idea that we could actually have an explicit dollar policy. Now, saying you want a lower dollar and getting a lower dollar are two different things, but there are also some policy levers that the Treasury Department and the Federal Reserve could employ if they wanted to achieve a lower dollar. So I think that's a really interesting scenario, and of course, you're quite right, it has a big implication for international investments. Because if the dollar falls, it's going to mean that the returns people get in dollar terms on international investments go up. And right now, 65% of the global market is just U.S. equities, the global equity market. So it's a huge percentage. That means the U.S. investors are very important in this. If they see better returns coming out of international for a year or two, you may see a reallocation towards international, which might cause us to enter a period which has been waiting for a very long time of actual international outperformance.
Thank you, David. I also want to talk a little bit more about the tariffs issue. What have we learned about the impact of tariffs on the US economy, on things like inflation and growth, since really this all kind of began in the first Trump administration? And how should we put this in the context of the outperformance of tech that we've seen? There's been a lot more focus around trade restrictions and maybe this kind of AI arms race that's happening globally. What kind of policy changes could you see come to fruition over the next couple of years that could challenge maybe some of the outperformance that we've seen in those names?
Well, I'd love to bring Liz back into this. I'd like to say a word or two about tariffs and macroeconomic impacts, but I'd be very interested in hearing Liz's opinion on where we are with all this trade policy in general. On tariffs, economists have always known that tariffs tend to push up inflation and tend to slow economic growth. The tariffs began to have that effect a little bit in 2019. You could see it. You could see a lot of people complaining they couldn't find parts or whatever, and you saw inflation beginning to creep up. But all that just got completely wiped out or impacted by the pandemic, which is a much bigger issue than the tariffs in terms of global trade. So to some extent, we didn't see it fully play out. But what we saw did suggest that it was somewhat inflationary and somewhat depressing to global growth. But it is, we're now past the pandemic. We've seen the effects of supply chain disruptions in general. So Liz, I don't know, do you do a view on where trade policy might be going under either scenario or any of these scenarios?
I think we have a little bit of an advantage because we got to see how the Trump administration operated with tariffs and trade policy for 4 years already. We are expecting many of the same players to be back in the fold. People like Bob Lighthizer, who was head of USTR and really driving that tariffs agenda with that White House, is largely being considered for cabinet secretary if Trump was to come back to the White House. So we would expect the same narrative to be back in play. Everything from what we've heard on the campaign trail, universal tariffs for all imports to very, very significant tariffs for anything coming from China. The Biden administration, if it was to turn into the Harris administration, again, it's sort of status quo. They have not been soft on trade policy, certainly using a lot of tools like Commerce and USTR to make sure they're using 301 sanctions, 232, all of the trade jargon that makes tariffs and such for things like solar products. It's just a little bit more nuanced than what we see from the Trump administration when they're talking about, and the Trump campaign when they're talking about universal tariffs. But those are largely the narratives we're seeing. And those are one of the areas where we don't really need Congress to be involved. It doesn't matter as much who's in the House and Senate. Trade policy is something we're watching because they can run this from the White House, from Department of Commerce, USTR, all these angles that are run by the administration. It doesn't really matter who's in the House and Senate. They can do it without them.
And circling back to one of the earlier points on, the Tax Cut and Jobs Act, which are due to sunset at the end of next year, Trump has also talked about the potential for more additional tax cuts, further lowering the corporate tax. Could we potentially see that from a Trump administration?
This is one where Congress absolutely is in play because Congress has to write the law, has to pass the law. They take a lot of direction from the White House if they're the same party. But if it is the Republican control of the House and Senate and the White House, there's a lot of coordination there. If one of those chambers or the White House is Democratic while others are Republicans, this gets so much harder to do. We end up at risk of things sunsetting because they can't reach a deal, or even a straight extension, just because there's not going to be as easy a time to figure out some sort of nuances of a deal versus expiration or straight extension. So all of this is so highly dependent on who wins the White House and who wins control of both chambers. That number that David cited earlier about the fact that this is a essentially $4 trillion decision, if they just extend what is in that bill, this is a very big number in Washington. There's a lot of Republicans in that chamber who don't like spending big numbers, who don't like the idea of $4 trillion at cost of just doing straight policy. They'll be looking to figure out how do we make that number smaller and what do we have to do about that?
Right.
David, I'm sure.
And of course, the problem is that a corporate tax cut makes it bigger. And so that's what I know the Biden administration has been proposing returning or increasing the corporate tax rate. But if I had to make a bet, I'd probably say this, 2 years from now, the corporate tax rate is just where it is today.
Yeah. Reminds me of the kind of like the Build Back Better that was championed on the campaign trail versus what ultimately was passed through Congress. That can be two very different pieces of legislation once you actually have to secure congressional approval. Liz, I know one other question for you. We did have the Republican National Convention last week. What did you learn, I guess, from it in terms of policy priorities from the Republican Party going into this race?
I think what these tend to show us is sometimes an infomercial version of America, like an infomercial showing America like the best side of any party. We didn't see a lot of policies promoted from the stage from any of the speakers. There was, of course, narratives around immigration and crime that is expected with the Republican platform. And part of that is because if you ask voters what their number one issue is in an election, no matter their party affiliation, they will say the economy. But the number 2 and number 3 issue for Republican voters and often independents are issues like immigration and crime. So you see a Republican convention sort of speaking to their base, making sure those are front and center. I will say on the Democratic side, those top issues tend to be things like reproductive rights, Supreme Court. Those messages will be more front and center in a Democratic National Convention because they're, of course, speaking to their base as well. Both conventions, though, are highlighting the economy because of the fact that all voters, regardless of their political affiliations, do think the economy, inflation, and everything tied into that is their number one issue. Both want to speak to how they have the best plan versus the other side to address that.
Thank you, Liz. David, one of the issues that you mentioned was really energy policies. What do you think that the market implications are from the differences between a Harris campaign versus a Trump campaign around renewable energy and versus more traditional oil and gas?
Well, it's clear that the Democrats are much more aggressive in terms of a green transition than the Republicans are. That's a very clear difference. And I think when it comes to subsidies for green energy, I think therefore I think a Republican administration would be less positive than a Democratic administration. For fossil fuels, though, it's kind of interesting because what matters, I suppose, for investors is the price. And one of the things we've actually seen overnight is the price of oil fall. I mean, it didn't fall much, but it fell marginally. But right now, I guess we're at I would almost say equilibrium levels. We're already increasing U.S. energy production, we've increased it over the years, really regardless of who's been in the White House, and it is very significant right now. If we increase it more, then it's quite possible to see lower prices, and that would actually hurt energy investments. Whereas correspondingly, if you actually you make it more difficult to produce fossil fuels in the United States, you could see the prices go up. So it's I think for green energy, it's pretty clear that a Harris administration would probably be more favorable than a Trump administration. But for fossil fuels, not clear to me which way it works. I think you could get more fossil fuel production out of a Republican administration. Not clear that would, if that caused though a significant decline in prices, it would be it could work the other way. And then we also have to think about geopolitics here. To what extent would a Trump administration result in a quick peace or ceasefire, or whatever you want to call it, in Ukraine? That could have an impact on global commodity markets. You could, and I'm not sure how, what that would. Of course, conversely, a more aggressive stance on Iran might result in greater tensions in the Persian Gulf. That could have an impact too. So these are close calls. But I think it's on fossil fuels, it's really hard to say. On green energy, though, I think it is more likely that I think a Harris administration might be more favorable to green energy stocks than a Trump administration. But again, Liz, I was wondering, what do you think about that?
That's a good point. The one place where we're seeing some pushback from both parties has been on EVs. I think a lot of that comes from union objections to whether the EV plants are unionized versus traditional auto plants. So it's been a little bit surprising to see both parties sort of lining up against EVs. We may see some of that in the next administration, no matter who is in power. But for the Inflation Reduction Act and rolling out all these green investments, no matter how much rhetoric we see against it from some Democrats, a lot of jobs are being created in what would be considered red states. It is one thing to sort of speak out against it on a policy ground, but it's another to go out and actually try to pass policies to stop the flow of money that is creating jobs in your state if you're an elected official. So we're going to see if the rubber hits the road on rhetoric meeting action. But while we wouldn't expect a Republican administration to go forth and promote new green policies, the idea of them like pulling it back and trying to pull money back from the states seems like it's probably unlikely at this point. Something we're watching for, but definitely a little more unlikely to pull back old policies than to just not create new ones.
Thank you, Liz. David, I also want to spend a few minutes talking about, the current investment outlook. We recently wrote our mid-year outlook about a month ago. Some things have changed, and one of the big driver, I guess, in the markets over the last week has really been that expectation for the Fed to begin lowering interest rates in September and for the economy to achieve a soft landing. Could you just spend a few minutes on your expectations for the GDP print that is coming out later this week and what we might hear from Powell at that July FOMC meeting?
Yeah. So on the GDP print, as I said, I think it's going to be a relatively strong number, but I think it will mask a gradual moderation in growth. But I think I am not looking for any sharp slowdown because we've got some things working in favor of consumer spending here. And consumer spending is about 68% of demand. What's helping us is we've seen a huge rally in the equity market over the last 18 months or so, and that has generated a lot of wealth. So that's helping spending on luxury items in general. We are seeing something of a squeeze on lower income households, but still we're seeing wage gains which are above actual inflation. And I don't think people perceive that. I think that's that's going to be a problem for Vice President Harris, because I think people sort of remember how much prices have gone up. And if, when prices go up, it's the government's fault. But when their wages go up, it's because of their own ingenuity and hard work. And I think that's how people see it. So I think people are still very grumpy about how much prices have gone up in recent years. So I think that's still the case. But overall, it looks to me from an investment perspective, the economy is we're going to seeing a continued longer, wider runway for a soft landing. And I think that's what's going to happen. For markets, so long as this happens, so long as this is the narrative, it's kind of a boring narrative, but markets will tend to keep going. It's a body set in motion will stay in motion unless hit on by or attacked by some other big force. And right now, there's a momentum trade which seems to push the equity market up day after day, week after week. And you can see excess valuations creeping up, particularly in the mega cap stocks, where you're selling at a 34 times PE on the top 10 names in the S&P 500. So these are high PE ratios. But generally speaking, you have to have some sort of shock to disrupt this trade. And what tends to happen is you just get more and more distortion in markets until you get hit by that shock. So we don't see what that shock is right now. But I would say, we don't know when it's going to happen. But at some stage, there'll be a shock which tries to reorder the valuations within markets and across markets. Within the United States is much more expensive than other markets. But for investors, it's very important to recognize that could happen at some stage. So, okay, the returns in their portfolio are up, but the market itself is more concentrated. And if they didn't rebalance, their portfolios are also out of whack and probably more out of whack than markets are. I said in the US is 65% of global stock markets, which is, a record high, but most people's equity investments are way over 65% US equities. If they live in the United States. So I think people should not be complacent here. I think this is a time to rebalance. If you can do so using tax smart policies, or tax smart approaches, so you could try to use taxable dollars to rebalance, or already post tax dollars to try to rebalance a portfolio, if you don't have a tax liability to do so. I think also in terms of diversification, given the amount of debt out there, I think, yes, you need to be balanced between stocks and bonds look okay here. And I think it's okay to have fixed income in a portfolio, but you've got to realize that's probably not enough, because if you have a minor recession, maybe the 10-year goes from 420 down to 320, you get a little bit of a cushion there, but you don't get a big cushion in case you have a 25%, 30% sell-off in the stock market. So you need to think about, well, how else do I diversify myself? And part of that may be looking at things. I think that's why people need to be careful about being diversified and recognize that the risk within their portfolio is probably rising relative to where it should be. And so I think that's what people need to focus on.
Thank you, David. One other question I wanted to ask you, because one of your recent notes on the week ahead pieces were about risks and exposures. And in your piece, you said how you often get asked on the road, like what keeps you up at night? Mm-hmm. And some of the questions that we're getting in right now is like, what's the big surprise, the unexpected outcome that could potentially come out of this if either party gains control? I loved your message there about how it's not about the risk in the absolute sense, but your exposure to that. And I don't know, perhaps you could just share a little bit about that.
Well, yes, exactly. Because I get asked this all the time. Is people constantly ask me about your risks out there, and the truth is, you can identify some things. Your geopolitical risks. You can identify the possibility of the Federal Reserve doing something one way or the other. There's always a risk of a recession. But I think the history of the 21st century it tells us that most of the things that really impact markets are things you couldn't have predicted, like 9/11, or like Lehman Brothers taking down the whole global financial system, or the pandemic. That's what the economy is most vulnerable to. The economy is very good at dealing with a problem it can see in front of it. It's just very hard to deal. It has a hard time dealing with something that hits it from around the corner. So I think that's one thing to recognize is we cannot name all the risks that the things that keep me up at night. It's not so much as my friend David Leibovitz says, it's not so much what keeps me up at night, it's what wakes me up at night that causes the problem. So you got to worry about those shocks. But the other thing is just recognize that over the years, the economy has been very good at looking after itself. But a lot of people have gone to the wall nevertheless, because people need to be disciplined in how they invest. And what's happened is we have this long period of very low interest rates where people, the carrying cost of crazy was essentially zero. So people are piling money into meme stocks or Bitcoin or a lot of things which just don't make sense in terms of valuations. And this is when I think people need to be disciplined. It's very important when markets are high and people feel good about it. That's when it's important to be disciplined, because the biggest risk may not be what happens in the economy, what happens in markets. The biggest risk may be literally in your statement in terms of where you are invested and how that has shifted to become more and more aggressive over time, as the more aggressive bets have done very well in markets.
Thank you, David. And I guess circling back to some of your earlier comments, because I think we cut out there for a little bit, when finding those attractive areas to diversify, within equities, fixed income, you also mentioned alternatives. I guess where in international markets do you think that, investors could diversify into?
Well, I think there's actually a lot of opportunity in international markets, because if you look at valuations, and we have a page in our guide to the markets which looks at valuations across different global markets, they're actually pretty cheap in Europe, in Japan, Canada, Australia, in emerging markets in general, although you can differentiate within emerging markets. I will say, and I think there's an opportunity to invest in all those places. I put on a pretty spread out bet. The one thing I would say is, people, I'm sure you're getting a lot of other questions there about things that essentially could go wrong here in the United States. A lot of people worry of both sides about this. But if you're really worried that something could go wrong in the United States, then why do you have a zero weight to international equities? And I think it's more important in some ways just to spread the bet around the world, and not just to try and make a specifically focused bet on one particular area. If I had to pick these areas, I think there's a lot of perhaps opportunity in the Eurozone, where the euro is significantly cheap. I think the economy is doing a little bit better. But in general, I'd want to have a pretty broad international bet in a portfolio.
Thank you, David. And Liz, before we wrap up here, I just wanted to check if there's any other final comments that, you wanted to share around what we could see over the next few weeks.
Sure. I want to highlight what we're hearing about the Democratic National Convention. I know it's an infomercial, it's not real policy, but we're expecting it to sort of start out with a lot of Biden tributes, the way you've seen in the press, which is just, thank you, Biden, for your service, decades of service, 4 years in the White House. And then a lot of focus on the economic message. We really do think they're going to pivot to the economic message before then, of course, the next 2 nights will be the vice president, whoever that is, and of course, Harris. It is, we are still watching, though, the big four names that are still out there, which is Governor Shapiro of Pennsylvania, the youngest of the group, only 51, Andy Beshear of Kentucky, Roy Cooper of North Carolina, and Senator Mark Kelly of Arizona, also getting a lot of talk. Those are really the four names in conversation. We do expect some movement on that in the next few days.
Great things to watch. And David, anything else you wanted to say before we wrap up?
Yeah, I mean, maybe this is talking my own shop, but the thing I'll be most interested to see is what sort of speeches does Kamala make? And really, it's not about substance, actually, it's about style. Because I know that it sounds a little odd, but I've watched campaigns in the United States for many years, and if you can deliver a humdinger of a speech, and if you can sound really authentic and be authentic and just say what you think, you can scoop up votes in the middle. If you sound like you're trying to hit all the right constituencies, and you sound as if you're just trying to conciliate various groups, and you sound inauthentic, then you'll turn voters off. And so a lot of it actually comes down to speaking style. I've watched people, I'll be very interested to see what Kamala's Democratic convention speech looks like, because if you can either win it or lose it. And there have been great communicators in the White House in the past. Ronald Reagan and Barack Obama were both great communicators, but there have been a lot of people who've lost campaigns simply because they couldn't make a speech. And that'll be a really interesting thing to watch over the next few weeks.
Will you be watching the next debate, David?
Well, that's a whole other art. How do you get a positive message across without while trying to bat back the things the other side is saying? I think that's a different skill set. But you're right, that I think could have a pivotal effect also.
Absolutely. Well, thank you both, David and Liz, for your insights today. And a big thank you as well to all of our great marketing and digital peers that work. And if you haven't already, please do check out our Election Insights Hub on our website. We have a number of blogs and materials there on elections topics, as well as a custom slide deck. We'll be updating that later this week with the recent developments. And finally, if we did not get to your question today, please feel free to reach out to your J.P.Morgan representative, and someone from our team will be happy to get back to you. Thank you for tuning in, and have a great rest of your week.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from J.P.Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given, and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. J.P.Morgan Asset Management is the brand for the asset management business of J.P.Morgan Chase & Company and its affiliates worldwide.